Unlike any other business in Australia, the banks, the big banks, have a bailout fund at the Reserve Bank. It's a bit of a secret, this thing. They don't call it the bailout fund. That's dirty language for central bankers. It's called the Committed Credit Facility, and it's about $180 billion in size. What we've discovered is that the banks have been rorting their bailout fund. The bailout fund is meant to have a whole lot of liquid things in it, like cash, and things that you can sell immediately, like bonds. Now, bonds are government debt, and of course government debt has gone through the roof. It's $1.5 trillion now, this bond market. The good thing about bonds, this is Commonwealth government bonds, is that if you need to sell something to cash up, if the housing market suddenly collapses, the Reserve Bank helps them with this bailout fund. The thing is, instead of holding nice, safe Commonwealth government bonds, that $1.5 billion of liquid bonds, they've actually stuck their own bonds in there, their corporate bonds or their junk bonds. Now, as they're backed effectively by the sovereign, by the country, which is you and I, they don't really have too much risk in their own bonds, but these are high-yielding bonds. So what they do is they stick all their own bonds in there, they invest in each other's bonds, and they bet on each other's bonds, and they get a huge return. The other thing they've got in there, the other 80% of it, are mortgages. So the big risk in Australia is the bank's exposure to the housing market, to our home lending market. Aussies love their houses and their investment properties. Prices are higher than almost anywhere else in the whole world. And our leverage, our household debt to disposable income, the amount of risk we have as a household is around 200%. Now, mortgages aren't very liquid either. So if there was a meltdown, this bailout fund would melt down itself. It would be unable to cash up. So the government would just have to print more money to bail them out. So what's happening is ANZ has done the right thing here. It's realised that it shouldn't be punting other banks' bonds, because bear in mind, these banks actually own shares in each other as well. They've got significant equity holdings, shares in each other, as well as owning each other's bonds. When the National Australia Bank had a bond issue the other day, one of the major banks, believed to be Westpac, put its hand up for $500 million worth of NAB's bonds. It's very incestuous, this little banking racket. Now, the RBA and APRA, which is the prudential regulator, they both know this is happening, and it shouldn't be too long before they do something about it. Unlike the rest of us, we don't have bailout funds, we take business risk. Unlike the rest of us, we don't have $300 billion in freshly printed money sitting earning no interest at the RBA on deposit, besides the bailout fund. So here they are, gouging ordinary taxpayers, because if they were to buy Commonwealth government bonds, as the government would like them to do, and put them in this bailout fund, it would be a real bailout fund which would be liquid. They could sell those on the international market if the Australian housing market collapsed. Instead, they're punting them, making huge returns, and basically forcing the price of Commonwealth government debt to be higher, because if they were buying federal government or Commonwealth government bonds, they would force interest rates down. There you go. Bernie Madoff, eat your heart out. At Michael West Media, we don't have a bailout fund. We didn't get any JobKeeper. We pay full 30% statutory tax rate. We're funded by you, the community. So if you can tip in $4 a month, we'd really love it. Thanks for supporting independent media.